Welcome to GRE. I'm your host, Keith Weinhold. The presidential administration has made some weighty decisions that could affect the real estate market for years. Then, when it's time for you to sell your investment property, there are some smart ways to do it and some big mistakes to avoid. We're talking about 4 options for your real estate exit strategy, including the little discussed 721 exchange, today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. You're inside one of America's longest running and most listened to shows on real estate investing. This is Get Rich Education. I'm your host, Keith Weinhold. If you're working for the weekend, well, then you had better examine your Monday to Friday and start investing for leverage and income that's generated today. The good news is that down the road, when it comes time for you to sell your investment property, hopefully after decades of handsome profits, even if that is years away, there are a lot of good options for you, including multiple ones that are tax deferred and effectively tax-free. I'll discuss that later today. What we know and what history has proven is that savers lose wealth. Stock investors maintain wealth. Real estate investors build wealth. And I contend that within the discipline of real estate, being the investor is the best job of all of them. Because look, realtors rarely build wealth. Property managers that don't actually own the real estate, they also rarely build wealth. And the people on your maintenance team, they don't build wealth either. Now, as much as we might appreciate all these service professionals, I sure do, this is not meant to disparage them. I'm trying to help you pick the right lane in real estate. Know that you're doing the right thing. Do the right thing before you do things right. By their own admission, the National Association of Realtors, the NAR, they will tell you that the median gross income for a realtor is, do you want to guess? Any guess as to what the median gross income for a realtor is? It is $58,100. That's it. And realize that's the figure being reported by the trade organization that represents the industry too. Licensed sales agents' median income, that's even lower. It is $41,700, also per the NAR. I see myself, realtors that have been in business 20 years, 30 years, 40 years, and all that time, they have never bought a single investment property for themselves. Instead, a lot of them spend their entire career helping other people get rich while they never get on the treadmill. But do you know what is even crazier to me? Crazier than that? It's the number of people that manage properties, including some of my own property managers that I hire, and they don't own any investment real estate themselves. And I think that's crazy because managers are doing what is one of the toughest jobs in real estate, always having to walk that tightrope, arbitrating between the property owner and the tenant, and as a result, often pleasing nobody. They're sort of like the football referee, the baseball umpire. The property manager, they have to deal with the problem tenant. The manager has to bug the tenant to collect the late rent. And then your maintenance people. I just met up with a contractor that's putting new flooring in one of my rentals. He's got a sense of humor, and he wore this great t-shirt that says, "I'm here because you broke it." I love that. But now his compensation isn't too shabby, but he's trading his time for dollars, and the income stops when his work stops. The lesson is, be the asset owner. Now, this presidential administration has shaken up a lot of policies, good or bad, and we've got a bunch of new directives centered on the housing market. And really, this shouldn't come as any sort of surprise, since, be mindful, the current White House occupant is a long-time New York City real estate investor. Some of the more recent weighty moves that can affect you are banning institutional investors from buying single-family homes that they turn into rentals, and the other one is a $200 billion bond purchase program aimed at reducing mortgage rates. Okay, whether those two things happen or not, it's good to look at their effect, how they move a real estate market, because when you understand the effects, then you learn a lesson, even if you're listening to this episode 10 years from now. The move to ban institutional investors, we're talking about conglomerate groups like Blackstone and Invitation Homes. The move to ban them from buying single-family rentals is to try to reduce the demand and therefore hopefully lower the price of single-family homes in order to help affordability. Okay, that could work in concept, but here's the other thing that it does. There would be fewer rentals available on the market because most institutional investors do buy those build-to-rent properties. That's what they're looking to acquire. So it's sort of what most any real estate investor would want. They would get higher rents and maybe some somewhat lower purchase prices, or at least a lower appreciation rate. But this whole move to ban institutional investors, that is mostly a nothing burger. That's all we're talking about here, and here's why. You cannot undo the institutional purchases that were already made. And a lot of those got made, a lot of them, during the pandemic. So it would only be banning new purchases. And another important point to consider here is how small this market is. I think these institutional buyers make a whole lot of outsized noise and often get pointed to as the boogeyman for running up prices of real estate, but that's not true. Only about 2 to 3% of single-family rentals are owned by these giant investors, at least the ones that have over 1,000 units, okay? So this all sounds good as a political platitude. You're trying to do something about it. I sort of understand that. But this ban, it just would not move the market very much at all. Now, perhaps a slight move could be triggered in cities that do have a lot of institutional ownership, like Atlanta, Jacksonville, Charlotte, but really little effect. The second directive from the president is having Fannie Mae and Freddie Mac buy $200 billion worth of mortgage bonds. This is really an effort to drive down mortgage rates and bring down monthly payments and make the cost of homeownership more affordable. The translation here for you is that whenever you inject money into something, money tends to flow more freely and rates get lower, kind of lowering the dam wall height like I have given to you in other examples. When you buy bonds, that demand pushes up bond prices, which lowers bond yields, and mortgage rates are tied to those lowered bond yields. And as soon as this was announced, like the very next day, mortgage rates fell into the high fives. Yes, under 6% for the first time in 3 years. But the lasting effect of this, that's been studied, and it's been shown to reduce mortgage rates by about 0.3%. So not nothing, but sort of small. However, if they're buying down rates like this one time, well, then they might do it multiple times. So there you go. There are 2 recent directives from the president banning institutional investors from buying single-family homes and buying mortgage bonds to lower mortgage rates, neither one of them with seismic effects. It's sort of like the 50-year mortgage proposal that the administration made a while ago, and that's probably not going to become a reality anytime soon, if ever. Here's a question that I have for you, and I'll let you answer. Do you like free markets, or would you rather have big government? Well, each of these directives are more government intervention into the free market, whether you like that or not. Another way to say it is that stuff like this makes a lot of splashy headlines, but it's not a bigger deal than a Philadelphia Eagles football game. At least you know how these forces can move markets now. Straight ahead, it's the concise, definitive audio guide to selling your investment property. I'm going to detail 4 different ways that you can do it in this guide, including tax-deferred and effectively tax-free methods. When you're able to defer taxes over and over again throughout your entire life, they effectively become tax-free. You never have any tax obligation. Also, I will discuss one way of selling your property that you're probably not familiar with and you might have never heard about before in your life. I'm Keith Weinhold. You're listening to episode 589 of Get Rich Education. You know, most people think they're playing it safe with their liquid money, but they're actually losing. Savings accounts and bonds don't keep up when true inflation eats 6 or 7% of your wealth every single year. I invest my liquidity with FFI, Freedom Family Investments, in their flagship program. Why? Fixed 10 to 12% returns have been predictable and paid quarterly. There's real-world security backed by needs-based real estate like affordable housing, senior living, and healthcare. Ask about the Freedom Flagship Program when you speak to a Freedom Coach there. And that's just one part of their family of products. They've got workshops, webinars, and seminars designed to educate you before you invest. Start with as little as $25K and finally get your money working as hard as you do. Get started at freedomfamilyinvestments.com/GRE or send a text now. It's 1-937-795-8989. Yep, text their Freedom Coach directly. Again, 1-937-795-8989. The same place where I get my own mortgage loans is where you can get yours, Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than anyone because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. Start your pre-qual and even chat with President Chaley Ridge personally. While it's on your mind, start at ridgelendinggroup.com. That's ridgelendinggroup.com.
Hi, this is Russell Gray, the Main Street Capitalist. You're listening to the Get Rich Education Show with Keith Weinhold. And remember, don't quit your daydream.
Welcome back to Get Rich Education. I'm your host, Keith Weinhold, and I'm coming to you from Colorado Springs today, where I'm attending the Real Estate Guys Create Your Future Goals Retreat event. Yeah, a goals event. It allows one to get introspective. One part of it is learning how I can serve you better on this show every week, since I do pour a lot of thought into what I share with you here. Just how much did this event mean to me? Well, my team is in the NFL playoffs, and I was willing to miss some playoff football for this.
That's inexcusable. Inexcusable. Playoffs? Don't talk about it. Playoffs? You kidding me? Playoffs? I just hope we can win a game.
Yeah, that is, of course, the classic rant from former NFL coach Jim Mora. Maybe Jim needs to attend the goals retreat to put things into perspective here. Now, whether it's just a few years from now or it's decades into your future, at some point we're all going to exit the real estate investing game, even if it's not until the day we die. I'll talk about that. With whatever endeavor you're in, it is good to begin with the end in mind. There's a good chance that you're either in real estate acquisition mode now, or you once were, or you're going to be in that real estate acquisition mode in the future. But after this accumulation phase of your life, hopefully which you've turned into financial freedom through real estate, after that, you're going to be in the mode where, since you've already made it, you're going to want to just maintain the portfolio that you have or stop acquiring, or you will want to sell eventually. The good news is that there are a lot of good options for selling your property and doing it tax-deferred and effectively tax-free. Now, I will not talk about selling your primary residence so much, though. This is focused on exiting from your investment property. Primary residence sales rules with the IRS is that your first $250K of gain is exempt from capital gains tax if you're single, and your first $500K is shielded from tax if you're married. Quite a marriage incentive there. But as we focus on investment properties, this is influenced by a question from one of our older GRE listeners, 62-year-old Mark, who wrote in last year with such a good question, and I answered his question on air last month. I'll basically expand on that answer today. Mark said he has listened to every GRE episode ever, and therefore, congratulations, he made it. He reached financial freedom. And he's got a sizable portfolio. Some of his properties are paid off, others are leveraged. But see, Mark is hesitant to buy more property because he's already made it. His wife doesn't want more properties because she associates it with him having to do more work. Now, when you're still in pursuit of financial freedom, well, you don't mind investing a small slice of your time each month into real estate, a little light management remotely maybe. But once your residual income exceeds all of your expenses, well, then at that point, your time is going to start to become more valuable. So let's look at four solid options for exiting your property. And then I'm going to examine the pros and cons of each one. The first of four is simply to sell real estate in the conventional way, just a plain sale to a buyer where you see that it gets fixed up and you list it and you sell it outright. Well, the pros of this is that it gets you to your exit and it also turns your equity into cash. The cons, the downside of doing it this way, is that you're going to give up your ongoing stream of income. Your cash flow is going to be gone. You might have to remove tenants depending on your scenario. You'll have to fix up and stage the home to prepare it for the market. That could be as little as $5K or as much as $50K or more, depending on the size of your real estate. You're going to have to pay a real estate agent a commission of 3% or more and pay capital gains tax of 15% or more. That's 15. And you'll also have to pay depreciation recapture. And of course, you don't have to pay 15% of the total asset value. It's just 15% of the value gain during the time that you held this property. All right, so the tax and fix-up cost can eat into your profit with this first of four ways to sell your property, although you are still probably in for a pretty nice windfall upon the sale if you've held it for a while. All right, so the first way is a plain sale. And a lot of people would agree that is not the best way to do it, okay? It gets far better from here. The second sale option that you have is something that a lot of real estate investors like us are familiar with or have at least heard of, and the general public has not, and that is the 1031 exchange. You'll also hear it be called the 1031 tax-deferred exchange or the 1031 like-kind exchange because you trade your property up for another property that's kind of like it. It is a hugely powerful wealth building and wealth preservation tool. Okay, Section 1031 of the IRS tax code, that allows an investor to exit a property without incurring any capital gains taxes. That also does not trigger depreciation recapture when you sell your property. But in order for you to get those tax-deferred benefits, importantly, you have to roll your gain into another piece of real estate. Now, there are a lot of rules and nuances around 1031s. I have done multiple 1031s in my life, and they are so worth doing and amplifying your wealth building power. I will not cover all the rules and nuances, those things like the 3 properties rule and the 200% rule, and that rule about how you need to identify your replacement property within 45 days and close on it within 180 days and all of that, because what I've done is I've completely broken that down on the show with you here previously. And as always, I explained it in the most clear and coherent way that I could for you. I best did that on episode 143 of Get Rich Education. The name of that episode is Your 1031 Exchange Guide, Tax Deferral for Life. Now, there do get to be some numbers flying around here, so you want to listen closely. You might find yourself skipping back. For simple example purposes, in a 1031, assume that you bought a $200,000 duplex 20 years ago, and it's now worth $500K. You depreciated the value of the duplex every year, as is actually required by the IRS, assuming you took a total of $100K of depreciation over the life of your ownership of it, and you did not make any improvements to it. The basis of your property is then $100K, because it's your $200K purchase price minus $100K in total depreciation write-offs. When you sell the property for $500K, you now have a gain of $500K minus $100K, which is $400K. Depreciation recapture and capital gains are not taxed at the same rate, and it depends on some things, but let's assume that your blended tax rate is 20%. That means you would owe 20% on your $400K, so that would be $80K in taxes if you just did the plain sale. But not many people want to stroke a check to the IRS for $80K. So instead, if you take your $400K of gain and roll it into a new property or properties, you can defer your obligation to pay this $80K. Yes, you do not owe the IRS a thing. Now, this is beautiful. You get that tax break virtually nowhere else in the investing world. Okay, so what you've now done is that you have exited the property, a duplex in this case, via 1031 exchange, and you've traded it up for another property. So you're still a real estate investor. You have not exited being one of those, but you sold the duplex and replaced it with another property or properties. All right. That was the second of 4 sale options, the 1031 exchange. And yeah, as you can see, there do get to be some numbers flying around. Some deep dive learning for you here. And that's why I lightened it up with the Jim Mora clip before we dove in. The third way is called refi for life. Now, we could almost put an asterisk on this third way, because with a refi for life, it's not a sale of the property at all. What it is it's really a way for you to sell your equity to a bank, yet still retain the property. Therefore, you access capital without triggering any taxes. You get a nice big windfall payout while you still hold the asset, and it keeps paying you up to 5 ways at the same time. Yeah, you will also hear this refi for life strategy referred to as other things. Refi till you die is one way to put it. As equity accumulates, say every 5 or 10 years, you just do another cash out refi, enjoy the tax-free windfall, and keep holding on to the asset. That is the same thing. Other names for this repeated series of cash out refis throughout your life that you might hear, which I'm calling refi for life, those other names are live on leverage, the equity to income strategy, the infinite hold, the generational hold strategy, hold until step up, or you might hear buy, borrow, never sell. They all mean the same thing. I'm calling it refi for life. Let me give you a simple refi for life example using conservative assumptions. Say that today you put a total of $200K down to control $1 million worth of rental property. Your initial loan balance is $800K. We'll just say your cash flow is 0. Your properties appreciate at 6% per year. After 10 years, your $1 million of property, growing at 6% annually, is worth almost $1.8 million. If you refinance at 75% loan to value, your new loan amount is $1.35 million. You pay off the original $800K loan. That leaves you with roughly $550K of cash out refinance proceeds. Congratulations, you got a windfall, and your $550K is tax-free loan money to you, not income, because the IRS says debt is not income, therefore it's not taxed. Yes, and you heard that right. You can do whatever you want with those funds. What you've now done is you pulled out more than 2.5 times your original $200K investment, and yes, while you still own the property. You continue to hold this appreciating asset, tenants keep paying down your debt over time, and inflation keeps working in your favor. All right, and remember, that's only what you did at the 10-year mark. You are not done. It just keeps getting better. Fast forward 5 more years to the 15-year mark. At 6% appreciation continuing, your original $1 million portfolio is now worth about $2.4 million. At 75% loan to value, that property supports total debt of roughly $1.8 million. At this point, your existing loan balance from the prior refinance, it's still that $1.35 million, so you pay it off with a new loan. This allows you to extract an additional $450K of tax-free cash. So added up, this means at the 10-year mark, you got $550K, and then here at the 15-year mark, you got another $450K. Across your 2 refinances combined, you have now pulled out a cool $1 million in tax-free loan proceeds. That's nearly $1 million of liquid, usable capital from an original $200K investment that you made 15 years ago without you ever selling the property. You still own what's worth now $2.4 million worth of property. You've got the $1 million liquid, and you still have not triggered any tax at all. So at this stage, you can just live off your $1 million of refinance proceeds, or you can choose to reinvest it into new assets, or you can selectively pay down your debt to increase your cash flow, or you can simply hold and let inflation continue shrinking the real value of your loans, and let inflation continue to make your properties go up in price. Then, down the road, when you eventually die, your heirs receive a step up in basis, largely eliminating capital gains tax. That is just amazing. That is refi for life in plain English. So that is the third of 4 exit strategies that I'm sharing with you here today. And understand, there are a few caveats here. I only went to the 15-year mark. You can keep doing it every 5 years beyond that. It just keeps getting better as leverage compounds the value of what you own. Now, I kept it simple for learning purposes in an audio format with you here. You're probably going to have even more equity than those numbers I gave you because I didn't even include the principal paydown that your tenants make for you. And let's discuss a few more pros and cons of this refi for life plan. The pros are that you've borrowed, and you've done that with perhaps a home equity line of credit, home equity loan, or a second mortgage. You've borrowed against the property in perpetuity and get tax-free cash. Interest paid on the amount borrowed is tax deductible too. If you don't have enough tax advantages, there's also that. You've got 0 property sale transaction friction or risk. You pass along the value of your home or portfolio to heirs on a stepped-up basis. What that means in essence is when you pass away, your depreciation recapture and your capital gains are wiped out. That's what a stepped-up basis means. Okay, those were the pros. The cons, the downsides of doing this, and there aren't very many, but it's that it does not get you out of property ownership while you're still alive, if that's what you're looking for. Your property cash flow gets reduced when you do a refi because you have a new debt service obligation. However, you've also got incremental rent increases throughout time that could offset that. And the other thing is, think about your heirs. sometimes heirs find it challenging to divide homes among themselves. So your heirs need to be pretty well educated on related real estate and tax principles. So those are the cons of refi for life. We're talking about 4 distinct exit strategies for your investment real estate today on Get Rich Education Podcast, episode 589. I'm your host, Keith Weinhold. And the 4th way, the least understood and least utilized way, is known as the 721 exchange. And I want to thank a different GRE listener named Nate in California in his Acquire to Retire blog. It's worth checking out. I want to thank Nate for his contribution here. Nate heard the GRE episode last year about 62-year-old listener Mark's desire to sell, and that's what got Nate to write in about the 721 exchange. Yes, just like the 1031 exchange is named for that particular section of the IRS tax code, it's just the same with the 721. And of all 4 methods we're discussing today, it's the only one of the 4 that I have not done myself, so I have studied it. How the 721 exchange works is that, say you have a case where you're a rental property owner and you realize that you just don't want the hassles of landlording, but you like the financial benefit that the ownership gives you. What you can do is sell your home to a partnership and receive shares in that partnership. The 721 exchange rules stipulate that this is not a taxable event, and therefore no capital gains tax or depreciation recapture are due. Now that you're an owner in the partnership, you still get the benefits of owning the property, like appreciation and cash flow and such, and you get these benefits across a greater number of properties and markets, diversification, because you're a fractional owner in the other properties that are in the partnership, not only your own. And when you eventually pass away, your shares are stepped up in basis and can be distributed equally to heirs. And see, it is surely easier to divide shares among, say, 4 children than it is to divide your 31 rental houses among 4 children, because your 4 children are all going to have different goals and varying degrees of financial savvy. So the 721 exchange really is a great estate planning tool as well. So you will have this partnership that makes an offer to buy your property. Section 721 of the IRS code allows a property owner to contribute real estate to a partnership in exchange for partnership units. And of course, you are going to need to learn how to vet the partnership. Now let's look at some of the pros and cons of this. The upside, the pros are that it gets you out of being a direct property owner if that's just something down the road that you don't want to do anymore. No more repair requests or HOAs, property tax bills, insurance bills, vacancies, or property improvements. And of course, to hedge against that, I favor using a property manager to take care of that for me, but that is a different topic. But in any case, you also defer paying capital gains tax and depreciation recapture by rolling your equity into a qualified real estate fund. Some more upsides of the 721 are that you get shares in the real estate fund that offers you continued cash flow and possible appreciation. There's often no need for you to pay to fix up or stage the property for sale, no agent commissions to pay. You diversify your risk across multiple markets and properties. You get to contribute to, and you sort of become part of a like-minded community of real estate investors, and you peripherally stay attached to your real estate, even though you're no longer the direct owner of it. Now, of course, being a direct owner of real estate is where you get both the profits and the control. But again, after a decade or even 50 years of direct ownership, you're just choosing to be done with that phase. So the 721 is a permanent solution. There's no sort of next decision stress or risk. It is done. It is solved. And like I said, the shares are easy to divide among heirs compared to a portfolio of homes. All right, how about the cons, the negative of a 721 exchange? Well, you're going to forfeit the ability to borrow against your asset, the refi for life plan that I talked about in the 3rd way you can sell your property. Also, you're going to have to pay some onboarding fees or some management fees to the partnership, and you're going to lose future 1031 exchange availability. And that is it. That is the 721 exchange. Again, I want to thank GRE listener Nate from California for reaching out to the show, and he's got a great blog. That's what got me to study the 721 exchange some more. This can happen with an UPREIT. You've probably heard of a REIT before, Real Estate Investment Trust. An UPREIT, UPREIT, that is an umbrella partnership REIT. As investors, we acquire and hold real estate for the long term because it provides those real estate pays 5 ways benefits of appreciation, cash flow, ROA, tax benefits, and inflation profiting. But as you begin with the end in mind, it's good to be aware of your options so that you can optimize that inevitable exit of yours down the row. To summarize, what you've learned so far on this segment of the show is that there are 4 viable exit strategies for real estate investors: the straight sale, the 1031 tax-deferred exchange, refi for life, which isn't a sale at all, it's a series of cash-out refis, and finally, the 721 exchange, where you sell to a partnership, all with their various pros and cons. So some really good options for you. You can look up Ridge Lending Group if you want to do a cash-out refi on your investment property. They're very well versed in how to do those things. That was the third strategy, the refi for life. What do I personally recommend that you do? Well, I don't know your situation, but I can just tell you what I do myself, and that is generally, if I like a property, I keep doing the refi for life thing. Continued cash-out refinances, and I just keep holding on to the property and enjoying that tax-free cash. That's if I like a property. If I don't like a property, I will be more likely to 1031 exchange it up into something larger. And when I'm older and done being a direct real estate investor, that's the time I'll probably take a close look at a 721 exchange and see if it's right for me at that time. How can you learn more about these 4 exit strategies and what professional parties might you want to use to help facilitate it? Well, it is the same place that you get free coaching from us, and it's also the same place where you find just the right next investment property so that you're going to have something to sell in future decades. That is it, greinvestmentcoach.com. That's free consultation with our coaches at greinvestmentcoach.com. I'm Keith Weinhold. Thanks for being here, but you weren't here for me. You were here for you. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.